Chapter 7 Quantitative Analysis Video 8 Banking Sector Ratios. Banking sector ratios. First is net interest margin or NIM. It is interest income received by the bank minus interest income given by the bank. Negative NIM tells interest expenses were greater than amount of interest income generated by the bank. If savings are high and loans given are low, then NIM will decrease. If savings are low and loans are high, then NIM will increase. These ratios are applicable to banks and non-banking financial companies. NIM formula is equals to interest income earned minus interest income paid whole divided by assets held by the bank into 100. Second is NPA or non-performing assets. It analyzes bank position for people who borrow money from bank and gets intentionally defaulter and are unable to pay the bank. NPA can be high by mistake or intentional moves from the bank also. When bank gives loan to someone who cannot be trusted to repay the loan with interest, borrowers become defaulter. NPA or non-performing assets are recorded on bank's balance sheet after a prolonged period of non-payment by the borrower. NPA or net NPA is equals to gross NPA minus provisions. Lower NPA bank is considered to be healthy. Third is operating income growth. Operating income growth is equals to operating income growth of present year minus operating income growth of past year divided by operating income growth of past year into 100. More operating income growth ratio, the better. CASA ratio. Its full form is current account savings account ratio. We know under a current account, bank pays no interest, while under savings account, bank pays 3 to 4% of interest. Bank needs to pay 6 to 6.5% of interest if someone deposits or make FD, and under CASA, they only need to pay 3 to 4%. On other hand, bank charges interest of around 9% or more if we take loan. Hence, proportion of CASA deposit is more than FD deposit that will eventually make bank pay lesser interest. That leads to more profit. Therefore, CASA ratio is equals to CASA deposit divided by total deposit. Interest expanded to total funds. It shows interest payable on any borrowing. Lower than 10% is good. Interest expanded to total funds is equals to interest expenses divided by total deposit into 100. Cost of income ratio. It is relation between income and cost. Formula is operating expenses by operating income into 100. Operating expenses includes expenses related to employees, rent, etc. And operating income is equals to interest earned minus interest expenses plus other income. Lower cost of income ratio shows higher profitability. Operating cost to assets ratio. As name suggests, it's operating expenses divided by total assets into 100. Lower the ratio is, the better. A good bank has this ratio decreasing over year and year. Credit to deposit ratio. Ratio indicates loan given to borrowers by the bank and amount received from customers to the bank. Its formula is total loan distributed or total advances divided by total deposit received. Higher the ratio means loans are high and deposit are low. For an example, bank gives loan worth 40 lakh and receive deposit worth 50 lakh. So it will be 40 lakh divided by 50 lakh into 100. That is 80. That means bank lends 80 rupees loan for every 100 rupees deposit. So guys, if you find this video informative, please do like, comment, share and follow Intellect Pantomath on Instagram and YouTube. Stay tuned for latest updates and more videos. Thank you.